Hello, hello, testing, testing. Can you hear me? All right. Hello, hello. All right, we'll get started here in a few seconds, guys. Appreciate everyone who's showing up. All right. If you guys cannot hear me, can you drop a comment in there? Hey, Bob. Good to talk to you again. Long time no talk. Awesome. Thank you, Mike. Appreciate you letting me know. All right, we're gonna give a couple more minutes, wait for people to show up. Wait, a couple more people to show up. This being said, it will be recorded, so this is not necessarily something you have to be here live for. Well, I appreciate everyone. Last night was a pretty big night for Tesla and SpaceX fans. I don't know if anyone here has read the S1 yet or watched any content or read anything about it, but Elon's really going for it. It's definitely the most exciting thing that I've seen in my lifetime. We're gonna do some deep dives on it, and for all you who are here on time, let me know what you think. I have some close friends. One of my longest time friends ever is a probably one of the biggest Elon Tesla bulls in existence. And I was talking to him last night right before he was covering the S1 filing. And if people are interested, we could definitely get some more. I could definitely bring him in for a subscriber only live stream. He's one of the biggest pundits, probably knows the most about the Muskverse and compared to everyone I've ever talked to and or read about. And if there's any interest in that, just let me know. Happy to bring in more experts so people can talk more to what they know about. All right. I'm not going to wait too much longer just because I do want to get this thing going on time. But we'll just give it 2 more minutes. And again, if anyone has any questions, comments, or anything, please put them in the chat below. I'll answer them in order and at the end of this talk. I did receive a bunch of emails, and we did pre-fill some slides with questions and answers. So we'll go through those as well, but it would be nice if you have questions that come up throughout this just to stack them, and we'll keep it loud and clear. All right. Well, I'm just going to go ahead and get started. And if you're just showing up or people show up later, they can go back and rewind. All right. Well, everyone, thank you for being here. I truly, truly appreciate your time today. It is 11 a.m. on a Thursday morning. So thanks for being here with me. And this one is for serious members only. We've recently crystallized our brand promise. We've been trying to be more clear about what we're about and what's our niche in the industry. And our new brand promise is see what others miss before it's priced in. And I think that's generally the theme of everything we talk about, but it's definitely the theme of today's quarterly discussion. So let's jump right into it. All right, so my job today is simple. I'm going to show you why I believe we're in the early stages of a classic melt-up and why our DCC heroes, those are our core thesis holdings, plus the new addition of Tesla, are the rational way to ride this market-wide melt-up. And by the end of this, I'm going to give you a clear 30-day action plan of what you can actually execute to make sure you're prepared for the upcoming couple of years here. All right, so let me put all my cards on the table. I definitely believe we're in the early stages of a melt-up. And that's not a normal bull market. This is the phase where stories will pull price faster than people are comfortable with. And that's all the stories and secular trends we talk about. That's AI, that's the digital transformation, that's the digital infrastructure, that's energy security, and also reshoring of manufacturing back to the US. Those structural tailwinds still exist and did not vanish just because the last 2 quarters have been fairly choppy. And the real risk, and I say this, I'm going to repeat this, but the real risk for someone right now is not another 10% drawdown. As we've seen, the market's pretty volatile, and as we talk about a bunch, Trump can basically dictate the market's ups and downs by a single tweet. And so the real risk is not another 10% drawdown. It's missing the 300% compounding window that may happen in a short period of time because the headline scared you into a cash. All right, so today's setup in just two minutes. I want to fast forward to what the market looks like now on a broad scale. Rates are higher and for longer. They did drop a little bit yesterday, but they are generally higher and for longer than we anticipated. But doesn't mean a recession, and we're not in one. Growth is still positive. CapEx, AI CapEx, and productivity are lifting margins for all the companies that invested in it heavily. And on the positioning side, pros have swung from euphoria to hedging, and now they're swinging back to a little bit more of euphoria. I don't know if you guys saw our article on Tuesday about Ken Griffin, his 5-month flip flop, but he went from being a complete bear to a complete unbelievably kind of entranced bull when it comes to AI within company productivities. But what this means is that pros have been hedging for a while, so they have more cash, they're long gold and commodities, and they have those trades that fit in what we call the stagflation category. And retail is unusually bearish. And that, to us, John and our research team, is the textbook early melt-up setup. That means pros are overhedged and underexposed. And it means they underperformed the benchmark last year. Literally, 80% of pros underperformed just the market last year. And that means their jobs are in jeopardy. But the big thing here, and what we like to harp on Market Capital, is that the big secular trends and stories are still under-owned. So let's dive directly into what is a melt-up. So my father and our research staff, our main head researcher, cut their teeth in the 1990s during one of the more recent melt-up phases. They watched the NASDAQ do things people swore were impossible. Greenspan at the time talked about irrational exuberance in the market, and that was in 1996. And the NASDAQ was around 1,300. And anyone who followed his punditry and pulled out into cash at that time missed on a move that went over to 5,000. I'm going to touch back on this exact thing in a couple slides, but I just want to start that on that point. People can be right, just not at the right time. And because of that, people miss out on massive gains. So being right about froth early is the same as being wrong. It just is. And a melt-up is that last phase where fear of missing out takes over and valuations stop acting like hard ceilings. So it's going to be more of a narrative-driven market and less of a valuation-driven market. And most investors think markets are about math and ratios. Most of the time, they're actually about emotion. And those emotions are usually fear and greed. And a little bit behind the scenes, the stuff about the financial publishing industry. There's a lot of people out. There's a lot of there's a lot of FinPub businesses. There's a lot of competition in there. And if you notice, if you receive any of their multiple marketing emails that they send out in one day, most of the firms, you'll notice almost all of the promotions revolve around two things. They all revolve either around fear or greed, mainly fear. It's because it sells. And so it's dangerous to get lost in the fear narrative. We try to stay away from all those, obviously. Maybe a little bit of greed, but definitely not fear. And so a melt-up is what happens when greed, FOMO, and most importantly, career risk take over the steering wheel for professional and investors. So formally, a melt-up is a sharp, unexpected surge in stock prices driven by sentiment and fear of missing out, not by fundamentals. It's the blow off the top phase where prices go absolutely parabolic and valuations stop mattering. In a normal market, prices discount future earnings. In a melt-up, markets become a storytelling machine. And the story matters more in this phase than the balance sheet. And that, my friends, is where we think we are headed. So here's how a melt-up actually works. The core driver is institutional performance chase. As we touched on, 80% of the professionals were underperformed just the bear market last year. And that's not good. They can't do that multiple years in a row. Their jobs are at risk. So as prices start to run, any professional who's underweight the winners starts to underperform badly. And if you're a benchmark manager sitting in cash or defensive stocks while the index absolutely rips, your real risk isn't cash, it's getting fired. So they capitulate. They buy the close to the gap. That buying pushes prices higher, which forces the next group of cautionary managers to join in. And it's a continuous feedback loop. We saw this in 1999. The Fed raised rates 3 times that year, but that didn't matter. The NASDAQ still finished up 85.6%. And the NASDAQ 100 traded around 200 times earnings. That's not a spreadsheet outcome. That's career risk. And you'll be right to point out when we talk about more at the end, the question action sensor. There is a point where the melt up stops doing a melt up and it does collapse. But we do think we're a few years away from that. And this is not really the topic of today's discussion because it's not actionable or now, but I'm happy to talk about this in the question and answer section more. And in a melt up, it's more dangerous professionally to be right and early than to be wrong with everyone else. And that's why it can run longer and get crazier than a rational do-it-yourself investor like yourself might expect. All right, so here's the part that most investors miss. In many cycles, most of the gains come in the final detachment from fundamentals. That's the melt-up phase. So think back to the example I gave in the beginning where Greenspan called it irrational exuberance, with the NASDAQ around 1,300. If you sold then to be safe, you missed a 300% move over the next 3 years. And as the index ran to over 5,000 by March of 2000, a 100,000 position, if you had a 100,000 position in the market and you listened to Greenspan at that time, you would have missed out on a gain of 297,000 because that same 100,000 position would be worth closer to 400,000 at the end of that peak. And mechanical tools like tight stop losses or selling at some PE target would have actually kept you out of because of the routine volatility on the melt up phase. It would have kicked you out of those trades and it would have kept you from capturing the vertical part of the move. So the playbook in a melt up is different. You want to stay fully invested while the core narratives are still intact. That's the thesis behind the thesis documents, behind our core holdings. That's what that is. And in this cycle, that narrative is AI and productivity. The time to leave is when the story breaks, not when the spreadsheet looks expensive. So all that being said, how can we position ourselves appropriately for a melt up? All right, we have four principles we're going to go over here. Principle number 1 is do not rotate out of category killers because some market pundit wrote something cute that's kind of made you angry or dissuaded you on the thesis. Category killers are dominators. And right now, there's a pretty big narrative out there to sell Nvidia and buy AMD, Intel, and Micron. And that's people confusing stock moves with business quality. Yes, AMD did have a historic rise over the last 2 years. That is true. And we did actually recommend getting into it at the beginning of last year. We did sell before the top. This being said, it is not the category killer. It is not the in Nvidia. Nvidia isn't just another chip name. It created the AI compute category. And we didn't get where we are by playing semiconductor musical chairs. Timing the market is hard, very hard. That's why most people are terrible at it. It's better to buy the killers and let compounding and time do their thing for you. And Nvidia released earnings yesterday, or two nights ago. And guess what? Surprise. 85% year-over-year revenue growth. Absolutely bananas at their scale. So they keep winning. They keep dominating. And Markham Capital subscribers got here today by owning the real winners and letting time do its job. All right, so what does this look like in practice? So for Nvidia, Nvidia has been a long-term hero of ours, and we bought it when most people thought of it still as a video game chip maker in 2014, and we added again during the COVID panic, and we have held through a lot of noise. And most of the wealth came not from finessing entries and exits, but from staying put through the market narratives. We talk about compounding a lot, and that's because it's the single biggest thing one person can do to increase their wealth with, and this is the big thing here, with the least amount of risk. Trading is risky. Investing in core holdings for names for long terms is not as risky. When they dominate the category and the trend is still playing out, it is not nearly as risky as trending in and out of tops and bottoms. And in a melt up, the cost of exiting a core winner too early is enormous. And that's the first mental framework I want you to lock in. And we have a lot of behind the scenes stuff on this, but one of the core tenets that's been drilled into me by our lead researchers. Hey, if you bought Nvidia at $22 every time it goes up by $22, you just add another 100% gain. And the thing is, that's great for people who've been here forever, but for new subscribers, what does that mean to you? Well, the best time to buy Nvidia was earlier, but the next best time is now. It will keep compounding. It will keep growing, especially during a melt up phase. So those numbers still work in your favor. Second principle, second out of 4, we want to own the stack, not the story of the month. So we don't just own AI names. We own the companies everyone else has to pay. That's the compute, that's the cloud networking, that's the networking infrastructure, that's the data, and that's the software to help manage and run everything. Also the software for companies sell to their customers. And if you think of this as building an AI factory, our goal is to own the businesses that get paid on every unit of capacity, regardless of which logo or pundit is loudest on CNBC. We want to stay out of the punditry and into the narratives that drive wealth. So here's what that looks like. Here's what that looks like within the DCC. Nvidia obviously is the compute backbone. Microsoft is our cloud and productivity layer, and they have everything from Azure to Office to AI co-pilots as they bring AI agents across all of their platforms. Broadcom is the connectivity and custom accelerator backbone, and ARM, that was the dog of our portfolio for a while, and we recommended subscribers buy into that 3 times, and it took a long time for that to pay off. I mean, not too long in the grand scheme of things, maybe 6-7 months, but it did, and it's paid off massively. ARM is absolutely ripping, and it's totally integral to the AI transformation. A new one for us is Palantir, and it's becoming the operating system for high stakes AI in defense and also across the industry. They have a revolutionary basically business model where they take a cut of all revenue generated from their products within a company. And so their per seat revenue generation is absolutely ridiculous. There is a moral argument about Palantir. That being said, this is not where we discuss that. And I'm happy to discuss that later. And last but not least is Oracle on this list. And Oracle has gone from a legacy dinosaur database to building AI supercomputers with a $500 billion backlog. And this is currently the stock in our portfolio that's kind of behaving a little bit by ARM. We recommend buying it, and it absolutely tanked a week later. Super fun for everyone involved. This being said, we stand by the conviction, and Oracle is placed to be the builder of AI for people who are not the Mag 7. And one of our favorite theses around Oracle is the sovereign AI thesis. We touch on it here and again, but essentially, if you're a country that needs an AI database, which the argument has been made that they all need their own to preserve their own culture, to preserve their own data, and to secure all of their own stuff within their own country, Oracle is probably the company you're going to hire unless you're China. Oracle already is in close relationship, Larry Ellison personally, with most of the world. And if you need AI and you need trust is at an all-time high, you're going to go with the company you're already doing business with. So Oracle is massive in this AI build-out phase. And this is the stack we want to own into a melt-up. And on top of that, we've talked a little bit about ancillary hardware and component providers. Astera Labs is a recent, pretty quick winner for us. They're the nervous system, basically the connectivity fabric that lets data actually move between GPUs within a data center. They've been absolutely ripping and roaring since we purchased them a couple of weeks ago. I think they're up 40, 50% as of today. Another one of those is Pure Storage, which conveniently changed its name one day after we bought it, which was super great for clarity between us and you guys, but it worked out. That's fine. And so Pure Storage is solving the power wall issue. They're making storage of power very efficient. And they're making it so that any lost power can be reclaimed as well throughout the cycles. And so you can use more energy for compute, and your basically your ratio of tokens per watt increases. These are the non-core growth hardware and component providers for our hero stocks. They're not replacements, but they're ancillary and probably should be in your portfolio as well. And even with these two ancillary investments, the principle stays the same. We want to own what every AI factory has to buy. All right, so our third principle: buy what the market underestimates, not what it already admits is big. Our core promise here at Markham Capital is to see what others miss before it's priced in, and this perfectly encapsulates that promise in action. We saw this with Amazon when it was just a bookstore. We saw it with Nvidia when it was just a gaming chip. There's not too many of these examples of companies that are like completely category crushing that haven't been built out yet. But we do see this right now, and we think the same pattern is going to play out with Tesla. That's why we've kind of been going hard on recommending it the last couple of weeks. If you only look at the delivery numbers of just their vehicles, it's an auto stock. But if you zoom out, it's something else entirely. And that's what people are missing. Tesla is not just a car company. Not even close, especially now. I mean, and it's unfair to compare them to Ford or GM. Those are dinosaurs held up by financial shenaniganry. But Tesla produces real numbers, real goods, and real products that blow their competitors away. I mean, we did a large brief on this. I'm happy to go over it again today too. But it's just a couple projects to name that make them not a car company. Is they just broke ground on what's called the Terafab. This will be the largest chip manufacturing plant in the world by history. Their goal is to have a per year output that's 50 times higher than the entire world combined. So if we were to take the entire world right now of what compute is put out, this Terafab facility, a little bit outside Austin, Texas, is planning to generate 50 times that amount annually. That's absolutely crazy. And you've got an energy division with Tesla Solar and batteries that's doing over $10 billion in revenue a year, and they actually have better margins on the energy side than they do with cars. And you got Optimus. Last night, Tesla had their event. Forget what they called it, but it was basically for people who had bought the last Model S's and Model X's off the lines. They retired the lines and they had a party for those buyers. Those lines are being converted as we speak to Optimus manufacturing lines. And by the end of this year, they plan to launch out of the Fremont facility a production rate of 1 million Optimus robots a year. And they're also building out a new part of the Gigafactory here in Austin, where they plan to launch 10 million Optimuses a year. So they will dwarf the amount of cars they've produced just in Optimus robots in here in a short period of time. And between all those things, it's not a car company anymore. Jason Calacanis has been very vocal about saying people will, looking back, will forget Tesla even made cars. I think he's right. I'm not sure who coined the phrase, but I definitely think he's right. And the market right now is still pricing this company as sedans. Kind of crazy. And I one thing that gets underappreciated, I know talked about, but underappreciated in the specifics, is the way Elon thinks. And I want to give one example that I think is a great story, but two recently came out with someone made a book and it was discussed in the book. But essentially, someone asked Elon, how did you come up with the idea for the Gigapress to make cars? And well, they wanted to be competitive in the car manufacturing space. And so I guess Elon asked at some meeting, how do toy cars get made? They're produced in the millions extremely cheaply. And the answer was through a press, through a press that, injection molds the materials and you stamp the car together. Well, there's apparently only 6 manufacturers of industrial sized presses in the world. And Elon and his team approached all 6 of them. 5 of the 6 said absolutely not, can't be done at a car scale. And the 6th said, maybe it could. And they took that as a yes and ran with it. And that's how you get the Gigapress. And so just that kind of the outside of the box thinking at scale and mass production, I think can't be underappreciated here, especially as they scale into space. Then lastly here on the Tesla situation, there's also the SpaceX connection. Tesla does own about $5 billion worth of SpaceX stock. And I haven't done the math since the X1 filing last night, but I think it would be basically, upwards of tons of billions of dollars worth of within SpaceX. So by owning Tesla, you literally own SpaceX. But I think that's kind of not the main story here. What I think the main story here, and I'm going to keep this short. We'll keep it moving. But I do think SpaceX eventually, or Tesla, I think they absorb each other because everything that SpaceX is set out to do, and it was repeated in their S1 filings last night, cannot happen without Tesla's manufacturing facility, specifically the Terafab and the Optimus robots. SpaceX cannot do what it needs to do without those two things. And inherently, those two companies should be vertically integrated instead of, one pocket paying the other one. So there's the SpaceX connection there. And so that's why we think Tesla is criminally underpriced for the opportunity that's coming on soon. And I just want to give you a little bit of a background on it because I personally, I actually did approach my father and our research team with the idea to add Tesla to our thesis, to our heroes, and presented this evidence, the case for it, and lo and behold, turns out with the help of my father and our research team, it was totally right. All of it's right. They got behind it. But I only say this because I want to show you my conviction in this stock personally. Is well, I have I have a wife and 2 kids, and I have a third one coming up soon. And 15% of our net worth is actually in Tesla stock. That's how much we believe personally in this one company. And that being said, you shouldn't size that high unless your risk tolerance is approved. But I just want to show you the conviction we have as Markmans in this stock at this time. And it's because Tesla does fit this exact pattern that my father made his career on. I grew up around him. I grew up obviously hearing about everything that happens. And so this is part of that pattern that my father made his name on. The market is obsessing over what it was while ignoring what it's becoming. All right. So for the rest of us who have more rational positions spread out throughout a company, or throughout different companies, where does this all fit into your system? How should your system look? This is a brief allocation slide. We still firmly believe that 40 to 50% of your investment portfolio should be in slow and steady compounders and some ETFs that are outsized in the 3% of stocks that matter. For those of you who've been around for us, we talk about the 3% of stocks all the time. I'm not going to go into it now, but essentially a tiny portion of the stocks account for the vast majority of all the gains in the market. So it's less about owning all the stocks and more about owning the right stocks. And our 70 list within the Compound and Conquer letter, that's the 70 stocks that we believe should be in your kind of slow and steady compounders. The next 30 to 40%, this is where the DCC heroes live. This is our long-term investment from the thesis document. These are our Nvidias, Microsofts, Broadcoms, ARMs, Palantirs, Oracles, and now Tesla. And for Tesla specifically, we do think it should be a stock play. This is a little bit of a caveat here. We have gotten a couple emails, people asking, if you're so convinced on Tesla, why aren't we holding some options on it? And the thing is, we take fiduciary, not literal fiduciary, but somewhat fiduciary duty of how you guys invest your money. You trust us. You buy our research, and we take that very seriously. And options, especially within Tesla, it's one of the most traded stocks of all time. The volatility there is ridiculous, up and down every day. Elon Musk doing something, Elon Musk not doing something, whatever. The stock goes up and down. So the options play is a timed bet on a pricing point. And for us to recommend that for you over the long term is just not, we don't find that to be the best use of it wouldn't be with our ethos. So we just don't recommend that. So that's why this play we do think should just be a cash position. All right. And again, what I want to touch on here is there's a reason you guys buy research from us. And it's because we want to convey a feeling for you. It's so easy to be manipulated by corporate media these days. And we just really don't want that to happen for you guys. And so how do we want you to feel throughout this melt-up phase? We want you to feel confident, not frantic. You should be thinking, I am not going to miss the defining wealth building shift of my lifetime. Not I hope I don't get whipsawed tomorrow. Because this melts up, if it does occur, and we do believe it's going to be big. And you should feel calm because someone rational, that's us and our team, is watching this and telling you when the stories actually break. And as many of you know, when there is something extremely important, we do work on the weekends to get those reports out to you to make sure you're taken care of by that Monday morning. And many of you have told me we have hundreds of testimonials, and it's been the best part of myself coming here to work at the company my father started is hearing the testimonials from everybody. From the you financed my first house to this has been a life changer in my retirement. There hasn't been anything cooler for me personally, and to kind of see those kind of testimonials. And that's the emotional bar we're aiming at here as a firm. Confident, informed, and sleeping well at night while, this is important, staying in the game. And just to connect the dots from the presentation, the DCC's job in a melt-up is simple, is to keep you from getting shaken out. You're getting early access to these mega trends. That's the companies we talked about ad nauseum here, the Nvidias, Broadcoms, ARMs, Tesla, and the rest. And we give it to you in a format that's only 10 minutes twice a week. Pretty concise. And you get specific, not vague recommendations with clear reasonings. And we don't take any money from brokers or ETFs or investment products, and we'll happily recommend you a cheaper ETF if something serves you guys better in our Compound and Conquer letter. But you've already bought the research, so I'm not here for that. But today is I'm making sure you are fully using it. And for a subset of you, especially those retiring, like one member who called me last week and wanted to upgrade to the bomb because, and I quote, he wanted to get serious about his next chapter in retirement. That's where you get more access, more macro and micro analysis of the markets. You get more picks, and you get more back and forth with the behind the scenes team here. You also get more help with sizing when requested. And as things get loud and fast, you get an extra ear to listen to. You absolutely do not need the bomb to execute what we've laid out tonight and with the 30-day action plan. But what you do get is an extra layer of support as this melt up unfolds, and that's exactly what it's designed for. And if anyone's interested in the bomb, just drop a note in the comments here or email me after this. Happy to get you set up there as well. All right, so let's make things really simple for the next 30 days. Over the next 30 days, I want you to do 3 things. 1, build into our DCC long-term holdings. These are our heroes. If you look at your portfolio and see that names like Nvidia, Microsoft, Broadcom, ARM, Palantir, or Oracle are tiny or missing, start closing that gap in sensible tranches. You hired us for this reason. These are the stocks we will repeat again and again because these are the ones that should be held for long term. And 2, add or size Tesla into your long-term holdings if you have not. And you should decide what real means for you, whether that's 2%, 5%, or whatever fits your plan. Just start it. That's it. And 3, I want you to write down your rules for each of your holdings, for your core holdings. No, this way you do not rotate out of category killers because of a scary headline. Do not let emotions drive hitting that sell button. And what we mean by write down your rules is, what is your one-line reason for buying the stock? Why are you holding it? Write that down somewhere. Notebook, spreadsheet, somewhere where you can see it before hitting that sell button. Because committing to trying to play the tops and the bottoms of markets is a fool's errand. It's hard. It's very hard. The pros are bad at it. It's the reason why 80% of the professional traders didn't beat the S&P 500 last year. And the last thing of this portion is commit to letting the secular trend and the story play out, as long as the thesis is intact. All right. So that's the framework. We're in an early stage melt up. The DCC heroes are our core stack. Tesla as the new high conviction play. And that's the very simple 30-day action plan. And I'm happy to go deep on any of the names we talked about and how I'm thinking about sizing within the growth, within our growth bucket. Or I'm happy to talk more about this Tesla SpaceX connection. What I can't do and won't do is talk about individual tax advice or drop exact allocations. That is illegal. We'll not be doing that. And with that, let's dive into your questions. If you have one, please drop them in the live chat below. I'll address them in order. And yes, I have drawn up a bunch of slides with questions that people submitted. So if there's no questions in the chat, I'll just start there. So the last thing I want to end on here is this kind of scenario is what we've been planning for. There's a reason we've been telling you time and time again to build into these core holdings. And it's because these are the stocks that will experience the most gains in a melt-up type scenario. The setup was the volatility. It's crazy to think about it, but we actually, I've told this story before, but I'll tell it again. I grew up with my father having a stack of canes in the corner of his office. And I think it's been maybe one of the best things that's ever happened to me is learning the story of the canes. The story is you want to be the old man with the cane. And the story is in Wall Street, when there's blood on the streets, the old man is sitting in his chair waiting for the final blood the final war wound to drop, for the final blood in the street to be there. And when that happens, when everyone's crying hysteria, the old man grabs one of his canes and walks down the street to the bank, and he buys everything he can because he knows the market will recover. And when everyone has large amounts of fear and everyone's crying and there's blood everywhere, that's when you want to be calm, cool, collected, and saved up cash. And that's kind of what's been happening the last year. We've had tons of volatility. And the story is always buy the bottoms in the core thesis holdings and hold. And when it comes time for a melt up, you reap the rewards. And that's where we're at. All right. Well, thank you. That was the quarterly update. And I'll just start diving into questions. And if anyone has something, please drop it in the chat. Happy to go over that. All right. So the most requested question was, Why are we still holding ServiceNow? What's the deal with it? It's down. It's pretty down bad. All right, so we're still holding ServiceNow because the thesis has not broken. The company continues to grow sales in the 20% range. The share price is down due to the investors' belief that the value of future earnings will be diminished by AI. It is a victim of the SaaS apocalypse. And we believe this thesis is entirely incorrect. And it's still showing up in the quarterly financial results. ServiceNow operates an AI business built from scratch with a $1 billion in annual income. And executives are saying that this business will do about $2 billion in fiscal 2026. ServiceNow is mission critical for companies in the middle and sits in the middle between IT, HR, customer service, and operations for government and enterprise clients. And enterprises have spent years adopting the Now platform as a foundation of truth. And the cost of leaving them is very high. Companies are more likely to use the Now platform to add AI into their current stack versus switching to an AI alternative. So the answer with ServiceNow is their sales are growing, profitability keeps rising, and their AI division keeps expanding. And they're heavily entrenched into government and corporate entities. And the the CEO is actually absolutely hilarious too. He had a recent interview about this, and not only does he look like a dude from the Jersey Shore with the big sunglasses, he talks like it too. But he brings energy and enthusiasm into an utterly dry industry. I mean, who wants to be the glue within the DMV of countries? I mean, imagine the DMV is boring to begin with, but the operational CRM behind it, that's super dry. So the fact that he can bring enthusiasm to that industry is incredible. So we really believe in the company's leader, and we really believe in the stock simply because the story has not changed. AI will increase productivity, and switching from them is very high. Hey, Bob, happy to answer your question, but I think it may have gotten cut off. Not the full thing may have not come through. It just says Joe on the in the chat. Oh, here we go. Awesome. So can you speak about possible new entries into ARM and Cadence Design? Also, any updates on Abercrombie & Fitch, which may be recovering but seems out of place in our portfolio? Great question. And I have just the prepared answer for you, only because this question was also submitted beforehand. So I really, really appreciate you here. So let me dive into that. So there are three kinds of dogs in any portfolio. There's three ways to judge a dog. The first one is thesis intact secular bets that are temporarily out of favor. We would consider that Palantir, ServiceNow, Oracle, and Meta. Those are basically narrative driven out of favor stocks versus the actual secular trend changing. The second is experimental or early stage bets with smaller position sizes and more binary outcomes. In this bucket, we would include Recursion Pharmaceuticals. That's why we recommended only a 25% allocation of your normal allocation you would put in for one of these stocks. They're the experimental things that could go to zero, but also absolutely take off. So you size the position appropriately. And then the third category is the cyclical, tactical bets that can get crushed in rotations. And this would be the Abercrombie & Fitch and Trade Desk. The Trade Desk is interesting because it is a digital advertising platform, and there are no humans required to place ads. It is a winner in the agentic world, just full stop, not a loser. With the more AI and more agents, the Trade Desk is set to win. The business is fine. And sorry. The problem with the Trade Desk is the market narrative around it is that it's absolutely getting demolished by competitors, but the truth could not be further from it. They keep gaining more market share and their revenues keep rising. So the absolute hatred that comes to the market seems kind of irrational. And the thing is, they're dominating their category as well. So the rule for something like this is if the business is doing what we bought it to do and the secular drivers are still intact, we hold or we'll even add onto weakness. So it could be we're not recommending this right now, but we actually are going to do a deep dive into the Trade Desk in the next week or so. We may, but we may not. But this might be an opportunity to actually drill down and add more to the portfolio of this company if we still, if you still believe in the thesis. I know we We still do. And the other portion of this consistent rule is if the story changes or growth breaks or the balance sheet deteriorates, competitive position may erode in the market. Then in that case, we will admit we were wrong and recycle the capital to a future trade. At this point, the thesis is still there. The market stare is still growing. So, you know, it is being hit super hard, but it's not losing ground to its competitors. So we still believe in the stock and think we should hold on to it. And who knows, it might be one of the winners of this next melt up phase. We definitely think it will be. One other company I would like to talk about is GE Healthcare in this bucket as well. So GE Healthcare, healthcare demand isn't going away, and it's leaning into imaging and innovation. And essentially, it's a bucket of two names. There's huge optionality around AI-driven drug discovery, but with Recursion Pharmaceuticals, we size that one appropriately. And Abercrombie and Fitch kind of sits near the third bucket. They're exposed to cycles and multiple different types of compression, and it can look awful when there's people are doing a risk-off tape. So long story short is we still believe in Abercrombie and Fitch mission. They try to switch to being more digital first. Is yet to be seen that that's playing out. In fact, the market is telling me that it's not. So Abercrombie and Fitch, out of all these names, is probably the one we're least behind at the moment. And so we do plan on adding in after the trade desk, doing a deep dive into Abercrombie and Fitch as well. So hopefully that answers both those questions. I know that was kind of a long way to answer that, Bob, but I really wanted to get into the three ways of how the three kinds of dogs that a portfolio may have and which one fits it in those buckets. And again, just to repeat those three, it's first is thesis intact secular bets that are temporarily out of favor. Two, it's experimental or early stage bets with smaller position sizes and more binary outcomes. And the third is cyclical or tactical bets that can get crushed in sector rotations. All right. Well, does anyone else have any live questions here? I do have these prepared ones, and I am going to go through them. This being said, I would love if there's any participation here to go through those first. All right. So Oracle is down a lot from our entries. Why keep both tranches? Great question. Well, as we discussed earlier in this talk, Oracle is the builder of choice for people who are not the Mag 7 for AI data centers. And if you want your own data center, whether you're a country, an enterprise, or anything in between, Oracle is your go-to guy. And right now, cloud services now account for about half of their revenue with Oracle Cloud Infrastructure, which is called OCI. It's actually growing at a 65 to 70% year-over-year pace, which is crazy. And because of that, we do believe it's going to keep growing, and we do think it's going to recover. It's definitely one of the stronger names in the portfolio, and I would not recommend getting out of Oracle. All right, next one is Meta. Meta is down. Did we mistime it? Is the thesis still intact? Well, we bought Meta because we felt it was attractive in the middle 600s. The business is operating on all cylinders with 3.5 to 3.6 billion daily active users, and its AI-driven ad targeting and auction systems have helped ad prices grow around 10%, and impressions jump high teens year over year, which is pushing revenue into the mid 50s on the mid 50 billion per quarter, and digital ad revenue roughly above 195 billion in 2025. The business literally has never been stronger. I don't know if you guys follow this at all. It's kind of niche internet marketing stuff, but Meta just dropped this thing called Andromeda. It's their new update to their ad network, and it's crazy. So we're actually going to start doing Meta ads soon. We did a previous campaign earlier in the year. It worked reasonably well, but we're going to be doubling down on it shortly here. And the thing to understand about Meta, especially as a business who will be using it, is the whole game is completely changed. So Andromeda, the whole point of it is you don't actually put in your demographics anymore on the targeting side. The whole thing is that the AI will read your ad copy or have an AI translate as what you speak into copy. And then based on that copy, the AI itself will know which demographics are most likely to respond to that copy and at what point. There's been some speculation they're actually tapping into biometric data as well. So they might deliver ads to you at at the exact moment your biometrics tell you or have said that you might be most likely to purchase. Definitely a little dystopian. Not sure if I like that. This being said, we are a business and we do need to grow, so we will be using it as a channel. But it is interesting how deep they're going down the AI rabbit hole, and they're basically putting most of the company on that pitch. And the Andromeda update is really one of those. Unless you're placing ads, you haven't really heard about it, and it has been driving profitability. And the next update Facebook plans to release is that you just tell them what your product is, and their AI will make ads, make copy, and then target people for you. So it's basically changing like kind of a Palantir model. They get paid on results is what their model will end up being. Right now, you still pay for ad placement and views, but they do plan to be a pay for results organization at some point, completely using Meta, which is kind of crazy. All right, so we have Palantir is down 20%. Is this just a trade gone wrong? Well, great question. And I want to start with saying something is that the DCC is not a trading letter. We do say this directly sometimes. I don't think we say it enough. The DCC is not a trading letter. We do not trade with the DCC. We do sometimes have medium-term holds, meaning maybe a couple months, but we do not try to time the ups, the tops, and the bottoms. We try to buy the winners in categories. And Palantir is certainly a winner in their category. In fact, they may have even invented their own category. There is no major technology business that is growing faster or has greater potential than Palantir itself. And we simply just don't know how big the business can truly be. We feel that this is like Nvidia in 2015 or maybe 2016. It's a new category. It's a new way to do business, and they're absolutely destroying it. So yes, their ratios are high, but maybe it's justified. We think so. All right. So thoughts on quantum computing. Thank you, Kevin. To be completely honest, we stay away from this, and this is for a good reason. So we don't talk about our sources a lot. In fact, I think we should talk about them more, but we don't. One of our major sources is a AI researcher, or basically a tech researcher now does AI at MIT, and we run all of the new tech, quantum, AI, and anything that's kind of trendy or trending through our one of our sources there at MIT. And basically, quantum is years away from it being practical, usable, or even doable. And it is just not a real thing right now. I think quantum is we think quantum is a tradable potential category purely based off of hype. This being said, trading is very, very hard, and the DCC is not a trading letter. So that's why we're staying away from quantum, because the actual real world applications of quantum have yet to really be seen at all. And what we try to do, as you can kind of tell, is find a category that has a secular tailwind and get the winner of that category early. And that's what we try to do here. And with quantum, it's not really, it is a category, but doesn't, and sounds like it might have a tailwind because it's next generation AI, but because there's no practical applications of it yet so far, we are not bullish on it yet. And we do think it's more of a trading opportunity based on technicals and hype versus more of an investing in investing frameworks. Thank you. I hope that answers that, Kevin. But that's why we're not touching it. We're not touching it till it's real. One thing my father, when I first started working here 6 years ago, I asked my father to define his stances. Like, hey, how do you define yourself? Like your approach to the market. And one of the things that 6 years ago was super not cool to say was, but he did say it, and we've stood by it ever since, is we've never touched crypto. Never did. Bitcoin now maybe is a thing, and we do talk about Bitcoin sometimes as a relevancy point for how the overall market's doing, but it never turned out to be a real thing. Still hasn't 6 years later. And I'm not saying quantum's that, but what I am saying is that we're just not going to touch anything until it's real. So one question we got asked was, so when do you finally say we were wrong? Do you ever say we were wrong and sell a loser? The answer is yes. You've been with us long enough. We've said we're wrong all the time. That's not all the time, but enough. And the simple answer is when the business or thesis changes. We sold DraftKings after holding it for a very long time because we couldn't see how the company, because we didn't anticipate the prevalence of prediction markets like Polymarket or call sheet bets. We didn't see those that rise coming because they came out of left field and they absolutely destroyed DraftKings and the thesis behind it. So that one we sold. We also sold Super Micro. As you remember, we had Super Micro pretty early. I think it was 2024 December. We bought it then, and it rose 300%. I think in like 2 months, and we sold. And well, we sold it because the company restated its financial statements with the SEC not once but twice. It turns out Supermicro was partially a front for getting China Nvidia GPUs. Crazy. But yeah, so the thesis of the overall industry didn't change, but the fact that the company restated its financials twice with the SEC, that means funny business. And it turns out, looking back, that was correct. They were smuggling massive amounts of GPUs into China. Honestly, I feel like that should have been a bigger news story than it was. But yeah, so we do say we're wrong. And for those who've been with us long enough, you do remember I think it was August 2022 when we told members to sell out of all their positions. We saw an incoming crash. That is not a smart thing to do from a business standpoint as a financial newsletter service. You pay us for recommendations, not for 6 months of no trades. But turns out that was the right thing to do because it was the right call. And so when we do see something changing or happening or a market about to pop or something along those lines, we will advise to strongly sell if we see that necessary. And right now is not that time. So what happens if the melt up theory is wrong? Great question, Paul. We are keeping BITO in the foundational ETF portfolio. What I meant by that is not touching crypto is we never got into stable coins, altcoins, shit coins, any NFTs or any of those things. Bitcoin has proven itself. I should restate here. Bitcoin has proven itself as a financial asset at this point. And so BITO is a stable ETF that we do plan on keeping in the foundational ETF portfolio. Thank you for that question and for allowing me to restate the narrative. It has been, Bitcoin has now been trending enough where it does seem to be act like a real financial vehicle. This being said, we still aren't going to recommend a holding of Bitcoin itself because that is still an unproven asset. But holding an ETF of it does seem to be a safer version. Bitcoin's interesting. I was around it in 2011, 2010. 2011, 2012. There were people around me that were using it quite a lot. And this is when it was less than $1 a coin. Did I miss out on that rise? 100%. Am I bitter about it? Actually not. But the origins of it or Bitcoin are very suspect. Just put it that way. I'm starting in. I've been working on a secret project, and I'm going to be diving into financial stories and the truth behind the scenes, digging back into Markman Capital's real journalistic roots. I'm going to be releasing a 10-episode series at a time, releasing the first episode soon. But we're trying to film all 10 before diving back in. And I'll have an episode on Bitcoin. So, Paul, I'll keep you in mind when I release it and make sure to send you the link to it. But Bitcoin's interesting. We'll keep it there for now. Anyway, so what if that melt up thesis is wrong? Markets are about narratives, and history tends to repeat. Many people were calling the stock market bubble in 1994, but prices continue to rise for another 6 years. The people who claim to have called the crash will never reveal their longer-term track records because the numbers are terrible. A big personality who's actually, if you look at his real track record, is terrible, is Michael Burry. He did call the crash, but he called it too early and lost all of his investors' money, and got divorced and ruined his life. Somehow a movie was made about him being a hero. That's fine, neither here nor there. But his real track record is not as good as his public persona of that record. The AI infrastructure trade is not going to end with Nvidia producing $50 per quarter in sales, or $84 billion in quarters per sale as of this week. And the large majority of investors are skeptical about its future. The AI trade will end the same way other technology-driven trades ended, with the IPO of hundreds of no sales. And these are the Me Too AI businesses. This will happen, and these cycles repeat. So what we're saying here is, when does the melt up thesis end? The melt up ends when we start getting IPOs of no-name AI companies. When we start getting the Figma, I mean, Figma did launch. It's early, but I think we think after the SpaceX IPO, after the kind of the cools down, because it's the biggest name ever, biggest IPO ever. I think they're aiming 1.57 to $2 trillion in this IPO as of last night in S1 filings. Once you start getting these no-name companies with no revenues pushing IPOs, that's when it's time to start looking the other way and start planning how to be cautious. But until that time, and we still think this is a few years away, 1, 2, maybe 3 years away, we want to be aggressively in the market to capture these parabolic gains. All right, we get this question a lot. Is if I'm new to the DCC and sitting mostly in cash, how should I deploy after this call? Well, the answer is easy. You should read the thesis document in the welcome email. The thesis document that we update once a month, and it's in the welcome email to the DCC letter, and that we reattach multiple times in a week and a half period to the letter after we update it. We update the entry points for all of our core holdings in that, and you should choose your favorite stocks out of there. And we say favorite on purpose because they're all great and they all should do well here. But the ones you feel most compelled about personally, you should buy large tranches of those, based on your ability, sizing, and risk tolerance of those holdings. And that's the thing you should do with the thesis document for new members. Maybe start with Tesla. Tesla looks pretty good right now. We love it. Definitely get some Nvidia on the next nosedive. Anyways, we're getting close to the hour here, and these are all the questions I have prepared. I truly appreciate all of you here. If you have any questions, please drop them in the chat. Happy to answer them. I'll hang out for another 10 minutes, or as long as the questions keep coming, I'll keep hanging out. But I do want to close on a. Thanks, Bob. Bob said, in the digital leverage portfolio, we entered a Tesla options position. That is true. I meant on a personal long options call. We're not recommending Tesla options. Within our options trading letter, we for sure will recommend Tesla. It's kind of two different mindsets here. So I appreciate the calling that out. We are obviously do believe in Tesla, and we do take an option on it. But the thing is, it's not exactly like a person. We are tracking and doing that one, and it is within the options letter. Just in terms of like, if you're just a DCC subscriber, this is an investment newsletter, and we're not going to be recommending options trades within there. And plus, within the digital leverage letter, it doesn't always play out this way, but we do aim for tight movements within a 5 to 14-day window. And so those are all the that's the time frame we like for stocks for option trades to play out within that letter, not over multiple months. And so that's kind of the big caveat here. It's more of a tight window of a movement that we see versus a long-term options trade. But thanks for that, Bob. Really do appreciate it. And so what I will end on here is there's a couple of big things going on behind the scenes right now. I will be the first to admit our user portal is not great. It took an incredible Herculean effort to get the current one going, and so we didn't want to touch it. But now it's been 3 years, I think almost to the day. I think actually 3 years. That's crazy. Actually 3 years to the day. I'm not happy with it, and I'm sure you guys aren't either. But we're currently in process of rebuilding the entire user portfolio. Sorry, the user portal, and I don't have a timeline on it. Probably 2 months, 2.5 months to be realistic. But we are going to build it out and make it much more interactive, much more personable, and much more transparent of how to find stocks, how to buy stocks, and basically what our portfolios look like. And we will finally be getting off of Google Sheets. Google Sheets is great, but we will have a more modern approach to showing you the portfolio in this new background. So that's going to a little bit update behind the scenes about the new user portfolio or user portal. It'll be a lot better, and I appreciate you all for sticking with us through this one. I couldn't be more excited about it. In fact, I think we're actually going to be adding a communities feature. We'll start out with the options letter. So within the options letter, we're going to start a kind of a chat community situation where we'll be posting daily trading charts. Currently, we post them all on X. So if you're into charting, hardcore charting for trades or overall themes, I highly recommend you checking out the company's Twitter account. That's at JD Markman on Twitter. And I also would highly encourage checking out. We did launch. So another new thing. So that's the user portal. That's the potential new feature we're going to launch within first the digital leverage letter. But one thing I do want you guys to check out is we just launched a brand new newsletter. It's absolutely free, and it's a daily letter. It's on Substack. It's on our Substack, but it's also a direct to you. It's called the Frontier Report. It's a daily letter where we try to dive into more tech stuff, trendy stuff that's going on in the market, and explain it to you and what that means for your portfolio. It's called the Frontier Report. And if you're interested, go to our website, sign up for our Friday letter, and you will automatically also be signed up for our daily letter called the Frontier Report. It's getting a lot of really great feedback already. We've been doing it on Substack for about 5 months, but we wanted to bring it to you guys directly too. And so we recently just launched it from our actual CRM system. It's called the Frontier Report, and we're trying to stay on top of everything tech. And as this space economy starts to take off, we're going to be diving really deep into space and what space looks like, and that's kind of why the idea of the Frontier Report, where the name came from. We want to make sure we ride this next digital transformation trend of taking over space with space data centers and robots on the moon. Let's go. And there's going to be an entire economy built off of that. One thing was clear from the S1 filing last night. The main takeaway from one of the mission statements mentioned in the beginning of the statement was SpaceX is trying to become the platform for which other companies can access space. So it is a platform play to open up a whole new economy, which is interesting. And so that letter will be touching on all things topical in that area. And it's free, absolutely free. So that's another exciting thing there. There's some other stuff going on behind the scenes too. This being said, I don't want to take up too much of your time. You've been with me for an hour at this point, and I value your time. So thank you so much. If you have any other questions, comments, or feedbacks, please let me know in the chat or email me at any one of our newsletters. I do see all those emails. It goes back directly to me, and I will reply. So thank you so much. Thanks for being with us. Remember, we want to invest in what others miss before it's priced in. Thank you so much. I hope to see you at the next call.